Welcome back, traders, as we continue with ICT's 2025 lecture series. Today, I'll be taking some lecture notes on his SMC Forex review on February 4th. Keep in mind that even though this is on Forex, his concepts do still work for futures as well. Now, before we get started, I'd like to ask you to help me out by giving this video a like and subscribing to help me get over 1,000 subs. Thank you so much, and let's get started.
Welcome back, folks. So today is Tuesday, February the 4th, 2025. We're going to be doing a Forex review. Okay, so dollar index on the weekly chart, take your attention up to this candlestick right here. That discount wick, when price is below it, becomes a premium array or premium wick. Notice the red level here, that's consequent encroachment because wicks we treat just like gaps. Okay, so note that level here, it's at 110.143. And then note this fair value gap right here. I'm denoting that as a potential inversion fair value gap. So should price trade lower on a daily chart, if we go below that, come back up in, targeting minor sell side there. If it were to break below it, close, and then start a new candle, trade up into it, and then ignore, or let's say this way, avoid trading back in the upper half once leaving below it. That's how we set the stage for inversion fair value gap that's bearish. So it starts with a buy side and bounce sell side efficiency, but then changes its characteristic to then looking for it to act as a premium array. Okay, so it's reversing its role. But not only that, it's qualified by not seeing price go back in the upper half. Now it can wick up into it, but we don't ever want to see the bodies lay in the upper half once it leaves it. If you see that, then it's probably not going to be a valid inversion fair value gap. Now, one of the things you can do for your notes, when you see this form, note the time frame that it's forming on. So if we see price go below it, come back up in and avoid trading in the upper half, and then it displaces once. You can use the lower time frame from, like, for instance, we're looking at the daily chart. We can go to a 4-hour or 1-hour chart, and the very next fair value gap that would be bearish, that would be a really good high probability setup to take us down into the next discount array. In this case, it would be this low at sell side and the fair value gap over here. So we have two discount arrays right there and an order block. See that? So there's three specific PD arrays that are converging around there. Now this is a little bit more intermediate term targets, but this is a very short term target and more intermediate term here.
Okay, so a lot to talk about. 3 things to note so far. First, treat wicks like gaps, meaning we can grade wicks just like how we grade the new week opening gaps and the opening range gaps. You can see he graded the wick on the weekly chart and see how price has a strong reaction off of 50% and the lower quadrant on the daily chart. Now, because this is above the market, this is a premium array, and seeing the reaction, this is potentially signaling bearish order flow. Now, the second thing is, how do we get confirmation? Well, there's a weekly BIST to the left. On the daily, it's a large, obvious fair value gap, and this was recently used as support prior to the reaction off of the quadrant level. So for confirmation, we want to see this support turn resistance, meaning we're anticipating price to trade through this and then come back to use it as resistance. Now note that it is important for the bodies to stay in the lower half to validate that this is an inversion fair value gap. Now lastly, what would be our target? Well, obviously the sell side liquidity below the swing low makes sense, but why not lower? Well, because the order block and the fair value gap here, there's a convergence of discount arrays. So if liquidity gets taken, we could potentially have a deep retracement or a reversal that we probably don't want to be a part of. Now, ICT said this is an intermediate term target, meaning we could look for lower targets on a weekly or monthly basis. Well, I don't know about you, but a daily is already a pretty high time frame for me. But let's continue and hear what he has to say.
But this is a very short term target and more intermediate term here. What changes that? If we go back above the consequent encroachment of this wick on a closing basis, these ideas are going to be put to the sideline for the near term. Hourly chart for the dollar index. You can see we trade up in that consequent encroachment of that wick on the weekly chart, and then the lower quadrant of that wick, which is the 25 level. And then we displace lower, institutional order flow entry drill here. Trades lower, it comes back up into the daily bearish order block. And I didn't mention that. Let me go back up. I apologize. This last up close candle here, that's a bearish order block. More specifically, it's a propulsion block because we have this mess in here. So that's why I'm focusing primarily on that one, because there's two volume imbalance in here. And this last up close candle, it's trading up into that, but it's not going beyond half of it.
So propulsion block is just an order block near a previous order block. Now, price will usually run away fast from that second order block. Now, if you want to watch his propulsion block video from his core content, I'll link it in the description.
Price trades up into it today and then rejects and goes lower. So that's what that level is. It's a daily bearish order block. So we start trading here, rally up, and then break aggressively lower. This is that weekly fair value gap I am expecting, and I might be wrong, but I'm expecting it to perform as an inversion fair value gap and then attack that minor sell side liquidity. And then we'll see if it even gets down there at all, if it wants to make another attempt to break lower and attack that convergence of those three discount arrays, the order block, fair value gap, and the sell side liquidity pool. All right, we're going to segue right into euro dollar. We're going to not need to look at the weekly or the daily. We're going to cut right to the chase of the hourly chart because everything would be the opposite of what we're expecting on the dollar index. Now, all right, here's a fair value gap right there, buy side and bounce, sell side efficiency. Market trades down to that on today's trading here, around midnight or so, then rallies up, creates another fair value gap there, reacts off of it there, sends us up into this old inefficiency and above this short-term high. But I'm going to take your attention to the SIBI right here. This is sell side imbalance, buy side inefficiency. When price is bullish, we expect this to act as an inversion fair value gap. So you can drop your fib on top of it and get the upper quadrant, consequent encroachment, red level, lower quadrant, and the low. And we shade it, or I shade it, just to help you guys follow along with the logic I'm thinking about in terms of these PD arrays. Whenever you see an orange one, I'm expecting it to reverse its role, okay, to support price. So the market does, in fact, trade down to its low here, then finds the support at that fair value gap there. And then look at the bodies. They couldn't even trade at and close at or below the lower quadrant. That's extremely bullish. The market rallies up. This candle opens, trades right down at the consequent encroachment, the mid-level, rallies, falls short of the high, breaks back down in, fair value gap there, and then rallies outside of it into this old inefficiency and above that short-term high. Notice these, very, very smooth, okay? So there's liquidity up in there. So if we have a sustained price run, I think that euro dollar could visit this area. I'm not telling you that it's going to do that. I'm looking at the price action, which is extremely sloppy right now in Forex.
So he always does this. He says, this is not trading advice. And it's not, okay? I do this too. I never give out trading advice. And it's for our own protection because there's manipulation in the market. Sometimes price can be unpredictable. But according to our analysis, this is the target that we are looking for. But of course, there is no guarantee that it will get hit. Now, in my earlier years of studying SCT, whenever I hear him say this, it would shake my confidence in the analysis, and a lot of the times I would do the opposite. And most of the time, it does not work out well. So if you're a new student, understand that this is the target, okay? As long as everything goes according to his analysis. You need to know where the analysis will prove to be invalid, but understand that he needs to say that it may not work out and that he's not giving trade advice for his own protection. But with that said, still be very careful. You're responsible for your own trades. You're to blame for your losses, and all credit is due to you for your wins.
All right, dropping down to a 15-minute time frame. See a little bit more detail here. Here is today's beginning at midnight. Trading down to that fair value gap, and then we rally up. Consequent encroachment, beautiful, inside a small little gap right there. And then rallies up, comes back down into another gap there, and a bullish breaker. Low, high, lower low. We're above it, there. Okay, and then it rallies higher, comes back down in, touches the upper quadrant level of the inversion fair value gap, then sends price higher. Look at the bodies, stopping at the inversion fair value gap high. That's this SIBI. Look at that, it's beautiful, isn't it? Beautiful. And rallies outside of it. Right, 5-minute chart zoomed in. Here we have the low of the day around midnight. Rallies up. We have London open kill zone. It's been a long time since I said those words. So we have a buy side and bounce, sell side efficiency. The market trades down into that handsomely. And that is your London open kill zone long, or the London open kill zone silver bullet. Okay, very, very easy methodology applied to London open. And then rally to this would be easy bread and butter setup, or upper quadrant level of the SIBI. That would be a nice target from here to there. Adding as a pyramiding, buy side and bounce, sell side efficiency, dropping down the consequent encroachment, then sends it, comes back down in, touches the bullish breaker, support here, and then trades down to, look at the bodies, right on the mean threshold. So look at that. The body's stopping right there during what? New York open kill zone. Rallies up, comes down to the top of the bullish breaker over here, then displays some higher. Beautiful fair value gap. Hammer time. Again, right in there, sends it higher, trades it outside the inversion fair value gap, comes back into this fair value gap here, and then starts sending it higher into London close. Segueing into British pound, 1 hour chart. Again, no need to look at the weekly and/or daily. It's going to be the opposite of what we see in the week dollar. So it's going to be bullish pound dollar. All right, so we have a buy side liquidity pool up here, and we have minor buy side liquidity here, relative equal highs. And we're going to look at these here later on, but right now, here's the same thing we saw in the euro dollar. SIBI, when bullish, it's going to act as an inversion fair value gap. Put your gradient levels in with your fib, which is the 75, 50, and 25 levels, respectively. We have the market show a buy side and sell side efficiency, institutional order flow entry drill, meaning it doesn't even trade it halfway or close the gap in, and then rallies higher. That is strength. We have another buy side and sell side efficiency, fair value gap here, rallies above. Again, institutional order flow entry drill, never even touches the midpoint. Comes back down in, touches the inversion fair value gap once more during the overnight at midnight time, rallies, comes back into a rejection block, which is lowest down closed candle, closing price, then rallies up and takes the minor buy side out here. 15-minute time frame, you see a little bit more detail here. We have the low of that SIBI when it trades up into it. Institutional order flow entry drill here and here. Consequent encouragement never is touched. Rallies, comes back down in. Institutional order flow entry drill on the buy side, sell side efficiency here. And notice the body stopping at the high that inversion fair value got right there. And here as well. They're all signals that the algorithm is saying it's going to go higher. Okay, just look for high prices. So when it was trading here, what's the easiest low-hanging fruit objective if you're going to look for something going higher? And you don't want to demand this buy side, and you don't want to demand this buy side, but you just simply want to ride something to the upside because you trust that this is telling you it wants to go higher. Well, what's this right here? Relative equal highs.
Okay, so I'm just letting him talk through the price action by pausing here just to remind you of those 5 core tenets in the first lecture. He mentions tenet number 5, aim for the low-hanging fruit. So just reminding you to keep those tenets in mind as we listen to him talk through the price action.
And we have another SIBI here. When the market's bullish, SIBIs turn into bullish inversion fair value gaps. So look at the bodies stopping right at the consequent encouragement level of that. Beautiful, isn't it? Rallies higher, down closed candle. That is a bullish order block on the 15-minute time frame. See it up here? 15-minute time frame, bullish order block. Opens here, trades down. That's your 8:45 time when it starts to spool price higher. Nice measuring gap. Rallies up into the minor buy side, but easily gets to the relative equal highs here, which were based on Monday's 4 o'clock highs. Okay, 5-minute time frame. Oh, I just caught a typo. That should say 15 minutes, not 5 minutes. So I apologize. It's basically the order block I just outlined on the 15-minute time frame. So we have the SIBI here, which is the smaller one. This was the larger one here. Now we went into this one. So just for sake of clarity, we're looking at this SIBI, and this is that large one. So you can see that little white fair value gap shaded area here, and then this one here. Now when we drop into a 5-minute, this is going to look big, and all of this is not going to be fully seen. This is going to show this little area and this area here. And that's what we're seeing here, that small little area of the larger one, and this is that SIBI. So it trades down to the low of it here, trades outside of it, creates a minor sell side liquidity pool with these relative equal lows during the London open kill zone. Trades up, creates relative equal highs, retraces back down into, in New York open kill zone, the lower quadrant of this SIBI, clears the minor sell side liquidity here during the New York open kill zone. Rallies up, touches the high of the SIBI, moves higher, creates a fair value gap that's bullish, and now we have what? Consequent encouragement, order block on a 15-minute time frame. That is not correct. It should say 15 minutes again. Trades to here, rallies up, clears minor buy side, rallies up, runs one more time, and this is a 10 o'clock silver bullet. So yes, it works in Forex. So it rallies up. We didn't get to the minor buy side here. Trades down to here, perfect stop at consequent encouragement, and then runs into London close. Now, let's say you want to trade in the direction of that first minor buy side liquidity pool, but you just don't have the conviction or the experience to hold for it. Well, you can take along in here, along here, along here, but then measure this high to that next liquidity pool. Every liquidity pool has in and of itself a midpoint, an algorithmic level that it will reach to. Okay, so it looks like this. If you take the fib and you anchor it to this high, draw it up to this level here, and just highlight the midpoint 50 level, that's what this is here. And you can see that's a very easy objective to reach for 1.2455. And we would call that a buy-sell liquidity pool. Now, it's not anchored to anything. It's out inside the range between two pools of liquidity. But just like when you're looking at these things that you feel are super science, these ladders, these DOMs, where it shows the buy orders and the sell orders above and below the marketplace, you don't need that. You do not need that at all. And if you start applying these concepts like I'm teaching you here, you'll be able to see that there's a lot of interest in that midpoint level there, and it never needs to go to this level here, which is how you learn how to trade inside the range and never require price to ever trade outside of it.
So a lot of good gold nuggets in this one. So like a lot of things, we can grade the liquidity pools, and now I'm noticing that we could be grading the projected run to our target and expect a measuring gap or consolidation at 50% and even at the quadrant levels. So very good review. I've given you my takeaways for this lecture. I hope you find it insightful. And again, make sure to like this video and subscribe for my future lecture notes. And until next time, guys, safe trading.